finance.
And Personal Finance is brought to you by Standard Bank Wealth and Investment. Standard Bank moving forward. Well, that's exactly what's been going on. And Warren Buffett has been making news headlines over the past week or so. Hundreds of people attending his annual conference in Omaha, Nebraska. It's seen as one of the ultimate business conferences as the billionaire discusses his strategies. Buffett has bought many companies, as you know, and has a huge business empire. Well, our own Warren Ingram, our financial advisor, went off to the Berkshire Hathaway gathering. He was our correspondent. He was there and brought back with him a wealth of knowledge as well. He joins us tonight to discuss Buffett's investment philosophy. Good evening.
Good evening. It is evening here. It's not afternoon. For me, it's afternoon.
Shame. How's the jet lag? Difficult, isn't it?
It was a lot of traveling, but I'm not complaining. It was definitely worth it.
How many hours getting there, and then what happened after that?
It took me about 25 hours to get there. So, I had to fly from here to New York, which was fine, and then New York to Minneapolis, which is really far from Omaha, and then from Minneapolis to Omaha. And the reason for that is because Omaha, where Buffett's hometown is and the head office of Berkshire, is a tiny place. The population is very small, so it can't actually cope with the influx of people. It's about 35,000 people that arrive in that town to come and listen to Buffett. 3,000 alone from China.
That's a lot.
So it's a big deal. And the first day that you would go would be a Friday. You would arrive, and for us, for example, I think you and I were chatting on air at that time.
That's right.
We would do one of our pilgrimages is to go to see Nebraska Furniture Mart, which is a business Buffett owns. Enormous place. I just can't give you the scale. I can't. It's so hard to describe. But if you took probably 10 of our enormous discount retailers, put them together into one place, and they've got 3 of those around the US. It's just enormous. So we would go and do something like that, and then we would drive past his house because that you have to do. And then the next day at 6 a.m. is when you start queuing to go into that annual general meeting, which the doors open at 7 normally.
Wow, that is phenomenal. You must be so tired.
I am, but I'm still. I think I'm buzzing a little bit. So so it's great. It's definitely recommended for anybody who can get there.
It must have taken you a long while to absorb everything that you saw and everything that you heard.
It's the second time that I've been, and it's interesting because his message is not the same every year, but there's a lot of consistency in what he says, and it's incredible how this time around I've picked up a whole new nuance to what he was saying before, and I'm very sure he was saying it in. But as you say, there's just so much information. He talks and answers questions with his business partner Charlie Munger, who I think is actually the rock star in that whole thing. They answer questions for 5 hours. So you're right. There's an incredible volume of information that you have to process.
When does Charlie take over?
Charlie answers. So Buffett will get a question. It could be a question from the journalist, an analyst, or audience member, and he'll answer. And then he'll look to his left and he'll say, "Charlie," and most of the time Charlie will say nothing to add. But every now and then there'll be a question, and before Warren opens his mouth, Charlie will say, "I'll take this," and it's usually where he wants to be critical of the question. So one of the questions that came up was about Coca-Cola, and they own a lot of Coca-Cola, and it was a question about why would you, in this day and age, endorse Coca-Cola, because they personally endorse Coke. They drank Coke and Coke Light respectively throughout that event, and they own so much of the share. But why would you do that if there's this huge issue about sugar and sodas, etc., etc.? And Munger answered that question so quickly,
Yeah.
And it's quite interesting. He would say you're quoting a study, but you're only quoting. His answer was the study you're quoting is immature and stupid.
Wow.
And he would say the reason why I say that is you're quoting only the downsides of this. What about the upsides of the health effects of being happy, the health effects of doing what you enjoy, and living a happy lifestyle? Because there are acknowledged benefits to being happy. The health benefits of being happy are there. And Buffett then kicked in and said, yes, because if you make me eat broccoli, I'm sure I would have been dead a long time ago.
I agree with him, actually. All right, let's look at Warren Buffett's investment philosophy. Determining if the asset offers good value.
So the whole thing about Buffett is he's definitely migrated his investment philosophy, or I should say evolved over time. In the beginning, he would buy really cheap companies at a really low price. So he would call that cigar butt investing, because you don't pay for that cigar butt, you pick it off the pavement, it sounds terrible, and you take your last puff and you get that puff for free. As he's migrated and got bigger, what he's done is he decides now to buy great businesses, but at a fair price. And that's quite a big difference. So if we just look at something like Coke, I mean, he might not have paid, the cheapest price possible for Coke, but he believes it's a great business. He believes it's got a great brand, and he believes that brand is so powerful that it gives that business a massive competitive advantage over its peers. And that's a typical Buffett philosophy. So he'll buy that business and try and hold it for the rest of his time.
I was watching him, and it was great because he does that. He says, I'm not going to tell these people how to run their own businesses. I'm going to let them run them. I'll oversee it, but they are the experts.
One of the fascinating things is that business as a group employs more than 360,000 people throughout Berkshire's universe, 78% of them in America, but that means there's quite a big chunk now sitting outside. His head office is 25 people strong.
Sure.
And so that tells you that they're not micromanaging anything. I mean, they're not even micromanaging themselves. So you're quite right. He employs wonderful managers, and he calls them managers. But I mean, in South African terms, these would be CEOs of companies. Very often, that would be the biggest company in South Africa. He leaves them alone because he said, I bought that business with that manager because it's a great business and it's a great manager. What am I going to tell the person about running a furniture business? What I can do is help him if he needs cash flow to build a new branch or something like that. I'll allocate capital for him. But I'm not going to tell him how to run a furniture business. That's his job.
Love it. Love it. Love it. Leave it to the experts. Right. Ignoring the fluctuating stock markets. That must be difficult, but talking about stock markets today, they certainly do fluctuate.
And it's something that we've probably said on the Money Show 1,000 times in the last 3 years. You cannot worry about the stock market going up or down on a particular day and trying to develop a long-term investment philosophy based on what you think is going to happen tomorrow. It's a crazy way of trying to make money, but millions of people do try and do that. And Buffett's view is, if you're going to buy a company, you need to be comfortable to hold that company if the stock market shuts its doors for the next 5 years. You mustn't be uncomfortable holding it for that long. And he would say 5, 10 or 15 years. And that's important. So you have to disregard what the market's doing when you're making that investment decision. You might use a low market to buy more of a great investment, but you're not buying it to say, I'm going to sell it next week or next year once the market rises again. That then is out of your equation.
Yeah, don't be silly about it. Also, buy as if you are never going to sell. I like that point.
So if you look at some of his businesses, he rarely sells them. I mean, I think he spoke a lot about Procter & Gamble this year because he's actually moved out of Procter & Gamble. But what he did was he took one of the divisions of Procter & Gamble, which is Duracell, the batteries, and he's holding that. But that's one of the few times where he'll get out of it. His first big investment was actually Berkshire Hathaway, the business originally was a textile mill, and it was a disaster. An unmitigated disaster. As we all know, textile manufacturers moved to the Far East, to Asia, and then to the South of America a long time before he bought that business. So he really made a mistake. But he held that for 18 years.
Wow.
To give you an idea. I mean, so even his mistakes, I think he probably would have liked to cut it earlier, but he tries to hold and try and work things out with the business.
Is it not always a point where you have to quit at some point and say, I've made a mistake? I mean, Barclays Africa, they seem to be thinking they made a mistake, or that's time to pull out.
Yeah, I mean, I think that's probably a point. And what's so fascinating about him is he'll talk about his mistakes far more than he'll talk about his successes. So that's an acknowledged mistake. That buying the Berkshire was actually one of his biggest mistakes ever. But buying a quality business and holding on to it. So he won't worry too much. I mean, I'm just staying on Coke because we started there.
Yeah.
So if the Coke share price doubles in a very short space of time, that's a fluctuation in the stock market. He would look at that and say, it's still a quality business. I'm still happy to own it. I understand that people are still going to be drinking these drinks because it's not just Coke. There are thousands of different brands in that company. So I'm happy to hold. Whereas if he felt that the economics for the business had changed, the fundamental reason why he bought the company, if that has changed, then he'll sell. But he won't change it just because the share price is moving up and down. He likes the quality business. They're hard to find. So he says, once I found one, I'm going to hold it for as long as I possibly can.
Very interesting. Understand the business you're buying.
So if we cast our minds back to the late 1990s when the tech boom was booming, and the internet of everything was the way to go, and everybody was throwing money at these tech businesses, he wasn't there. He just didn't buy them. And the reason was he felt he didn't understand the business case. Having a large number of views was great, but how do I make money out of that? And if I don't understand how I'm going to make money out of it, guess what? I'm not going to buy. Yeah. And so that was interesting because he avoided that tech bubble that then burst. But for example, now he owns about 9% of IBM, And the reason is because he understands the cash flow from that business. He understands it makes good profits, lots of dividends. It sits on a massive pile of cash itself. So now he'll buy it because he understands it as a business. So he won't buy a theme or a fashion or a trend. He has to understand that company properly before he'll get in there.
I was watching a video clip of Bill Gates and Warren Buffett chatting many years ago, and then he actually referred to that, saying at that point that he had spoken to Bill Gates, and Bill said, come on, invest in computers. He said, I don't understand this. I don't think it's going to work. But I think later on he took another avenue, but never went with Bill. Very interesting.
No, and what's interesting is, you would often be tempted to say, an 85-year-old man, what would he know about tech? He spoke a lot about the impact of Amazon and how Amazon is changing the world of business. He also said other online retailers. So it's not that he's ignorant. It's just that he's saying, if I can see a trend, that's great. But if I can't understand how to make money out of it, how someone's going to make money out of it, then I'm not going to invest.
So very interesting. And then buy businesses that have some kind of moat, in other words, a competitive advantage that allows him to price higher or resist competition.
So, we have to talk about the railway. He's got a business called BNSF, and in 2009 he bought Burlington Railway. And if you think about a railway, that's the very definition of a monopoly. If I buy a railway and I make sure that it works on time, that it's reliable, fairly priced, there's no chance that someone's going to build a railway next door to me. So that's a monopoly. That's the moat that he's talking about. It's a great example.
Let's take a quick call. It's Sello in Johannesburg. Hi, Sello.
Hello, yes.
Hi, go for it.
Fascinating discussion.
Thanks.
Yeah, but one can't help but wonder how wealthy Buffett would have been if he bought Apple or even Google 10 years ago.
You're quite right. So that's he's happy to miss out on the big rises in share prices if he doesn't understand them, because very often a lot of people also don't understand, and what happens is that business blows up, and he's not gonna do that to himself or his shareholders. So he's happy to miss those big ones. And you're right. It's a good point. But look at his wealth. He's the third richest man in the world. So it tells you he hasn't done a bad job.
You can't do everything, you can't.
You can't.
It's not everything. But Sello, nice points. Warren Ingram, our financial advisor and our Berkshire Hathaway correspondent, courtesy of Standard Bank Wealth and Investment. Great having you on the show once again.
Thanks, Ray. So, Philip, I've just come out of studio talking about Warren Buffett's investment philosophy. What's your perspective on value investing and sort of the choosing the right companies at the right price?
Yeah, no, it's always an interesting conversation, and well done in there today. So, yeah, value investing is a very sound philosophy, and I think it's something that many of us can subscribe to. The bottom line is you as an investor, you're looking for quality businesses that have a long-term prospects, something that's going to sit through any economic environment. You're obviously looking to pay a fair price for that business. And, Warren often talks about that intrinsic value, and it's absolutely right. You're looking for a business where you can reasonably work out the intrinsic value, and you want to pay a price obviously below that, and with sufficient margin to sit through any of the market fluctuations that might come your way. And of course, you're looking for great management in that business, guys that are going to be able to deploy capital, businesses that are generating positive cash flows, and of course the ability of those managers to use those cash flows to grow the business. And then of course it's sitting through the volatility of the markets, not getting caught up in the daily price. I think that's always the big challenge for investors. That, if you've paid a fair price for that company, and the market goes down, market price goes down, you haven't paid too much, and the market will revert over time.